Okay, so let's finish this chapter, International Rate and Currency Swaps. This is chapter 14 in our textbook, and it's going to be a very short chapter. So basically, how do we define swaps? Well, we know swap is a two-party exchange with each other for certain products, and in a swap, two counterparties agree to a contractual agreement wherein they will exchange cash flows at periodical intervals. Okay, and there are two types of international rate swaps. There is a single currency swap, and there is also a cross-currency swap, right? So the products we have here is a loan. So when you borrow a loan, as a borrower, you need to pay interest, and that's cash flow. So basically, two parties, one party may have a dollar loan and another party may have a euro loan, and one party pays the dollar interest, the other pays euro interests, and they could arrange a swap so they can exchange their obligations of interest payments to their best interest. Okay, so I have asked you guys to dig more into cross-currency interest rate swap. I have mentioned the mechanism of a cross swap in chapter 8 as one of the operational techniques for exchange exposure. And you guys' job is to do a little bit of research on the currency swap between the Greek government and Goldman Sachs in 2000, and see how that particular case of currency swap works. And that is related with cross-currency. So this is also called cross-currency interest rate swap. Usually the two parties, they exchange the debt services in fixed interest. Okay, it's not about other kind of interest, it's a fixed interest. So the fixed interest basically adjusts to the inflation of the two countries where the two currencies are issued. Let's say one debt is a dollar loan and another debt is a euro loan, and of course US and the eurozone may have different inflation rate, so the interest imposed upon these two loans may be different, and because inflation is different, the exchange rate will change. This is something we learned in chapter 6, purchasing power parity. Inflation leads to the adjustment of exchange rates. So in a cross-currency swap scenario, the two parties who hold and exchange two different currencies, two different loans, would also need to adjust their interests. And the major focus in this chapter is actually the single currency interest rate loan. In this swap, we exchange a fixed for floating. Okay, so one loan is requiring fixed interest and another is requiring floating interest. So fixed basically means the interest rate does not change at all for the entire maturity of the loan, and the floating basically keeps changing every day, or at least every month, just like your mortgage. When you pay mortgage, you can choose either to pay a fixed loan, let's say 4.25% for a 30-year period, or you can choose a floating rate loan, which could be a benchmark which fluctuates all the time, added by a premium. And here is the market of the swap. So in 2009, there is a statistics. The interest rate swap was $349 trillion, and the currency swap was $16.5 trillion. Okay, so that's a lot of trading volume we're talking about here. The US GDP is about this much, it's about $17 trillion, and interest rate swap is basically 20 times more than US GDP in terms of, and this interest rate swap is in terms of trading volume. So the major currencies being traded here are US dollar, Japanese yen, euro, Swiss franc, and British pound. And there's also a type of a financial institution in the middle as the service party. Okay, so we call them swap bank, and they basically playing a role to facilitate the swaps between the counterparties. So the swap bank could function as a broker or as a dealer. So as a broker, the swap bank matches the counterparties, but this broker does not actually possess any loans or issue any loans. So in other words, the brokers do not have inventory. They only do a matchmaking job. And for dealer, okay, the swap bank can be a dealer. They stand ready to accept either side of the swap and then later pay off the risk. So they basically hold an inventory of loans. So when I say they hold inventory of loans, basically that means they take the loans for themselves and pay the interests of those loans from their own pocket. Okay, so that's the difference between broker and a dealer. So without these swap banks, one party and another, let's say one company in the US, another company in the Eurozone, or Goldman Sachs and Greek government, they have to seek each other, so one look for another, and there are going to be a lot of searching cost, and that's not a very efficient way to do it. Because of the swap banks, then everybody can just go to the swap bank and get their best deal. So everybody can trade with everybody through a swap bank when swap bank is a hub of the trading. Without swap bank, so basically it's a bilateral transaction, so it's hard to find such partnership. All right, so what is the floating rate? So in this chapter, we use the London Interbank Offered Rate, or LIBOR, as the floating rates benchmark. It is a rate composed by the British Bankers Association, and this LIBOR rate is derived from a filtered average of the world's most creditworthy banks' interbank deposit rates. Okay, so basically, from your money and banking class, you probably have learned that the banks, they can borrow and lend to each other overnight, and they will charge each other a deposit rate. So these deposit rates of so many best banks would be taken average, and that average would be the LIBOR rate. And it keeps changing in a very short term, and every day you may have a different LIBOR rate. And the floating rate basically is a LIBOR plus a premium or a discount. Okay, so basically, if a loan is issued and is requiring a floating rate interest, then the interest would be definitely use LIBOR as the benchmark. And if the loan is perceived as a very risky loan issued to a very risky party, then the interest payment will be higher. So there will be a premium, a positive rate, or more interest added to the LIBOR interest. If the loan is perceived to be a safe loan or issued to a very secure business, then there could be a discount. So that means the borrower may pay a floating rate that is LIBOR minus that discount. And here is the quotation boards of different interest rate swap. And once again, these are all single currency interest rate swaps. So you have the single currency swap for euro, for pound, for Swiss franc, and for US dollar. And the swap basically is a swap between the fixed rate loan and the floating rate loan. So let's just take the first two columns here. So we have a bid and we have an ask, and that's for euros, the first two columns for euros. And we have different maturities. So when the bonds or the loan is due, so it could be due in 10 years. So let's look at the last two numbers. So this is a euro loan due in 10 years, and you have a bid and you have an ask. So the bid price is 3.85%, and the ask price is 3.85%, and the bid price is 3.82%. So basically, this 3.85 means if you want to buy a LIBOR interest, so you have to pay 3.85% for the fixed rate. So you have to pay that amount of interest, which is high than the bid interest. Okay, so if you want to get a LIBOR loan in exchange, you have to pay a 3.85%. And if you want to sell a LIBOR loan, then you can only receive 3.82% interest payment delivered to you. Okay, So basically, we always have a asked price that is higher than the bid price. And that is so because the dealer wants to charge the gap between bid-ask spread as the compensation for their service. Okay, so basically, in the standpoint from the perspective of the dealer, the 3.82 basically is how much they pay you for a labor loan, and for a floating loan, and the 3.85 is how much they receive for a LIBOR loan, and these are all loans denominated in euros. And of course, you have data for pounds, Swiss franc, and the U.S. dollar. Okay, so we will move back to get more practice later, so you would kind of understand how this system works. So far, just a brief explanation would not let you guys fully understand it, but we will get back there later. So some other definitions covered in this chapter. We have a euro dollar. So euro dollar basically is the U.S. dollar denominated deposits at foreign banks or foreign branches of American banks. So as long as the dollar is deposited outside the United States, it's called a euro dollar. Okay, so by locating outside of the United States, euro dollars escape regulation by the Federal Reserve Board. All right, and we also have a euro bond. And a euro bond is basically a bond issued in a currency other than the currency of the country or market in which it is issued. So here I got an example. So we have a bond that is denominated in US dollar, and it's issued in Japan by an Australian company. Okay, so this is following the definition of euro bond. So it can be called a euro bond, even though it's not issued in the European country, it's not issued in euro or Swiss franc, but as long as the currency that denominates the bond and the place where the bond is issued is different, we can call it euro bond. So basically, if there's a bond denominated in Japanese yen issued in US, that's also euro bond. And a bond denominated in euro issued in Japan, it can also be called a euro bond. For the company who issue it, it really does not matter. So basically, it can be issued by an Australian company, it can be issued by a Japanese company, by a Chinese company, by an Indian, Russian company. So the issuer, the nationality does not matter in this case. So we only focus on two things. One is the currency of the bond. The second is the issue place of the bond. Okay, so that's the PowerPoint file for this chapter 14.